Welcome back to Alberta Primetime and the Vocal Point now. Home sales drop, oil prices surge. Lots for our Monday Money panel tonight. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. Shafik Hirani is a senior director with Investors Group Calgary. And Beth Hamilton-Keene, a director and portfolio manager at Moore Investment Management. Good evening, everybody. Welcome back to Alberta Primetime.
Good evening.
Thank you.
Thank you. Shafik, the price of oil has shot up to about $100 a barrel. What is happening?
Yeah, there's been a lot affecting the price of oil. It shot up after Ben Bernanke announced the QE3, where he's going to purchase $40 billion of mortgage-backed securities. It went up all the way to around $98, $99 a barrel. Today it dropped, there's a little bit of a hangover effect. It dropped $2 today, so it's sitting around 96, 96.50. A lot of that cost is about projections about inventory levels, as well as there's been a lot of tension in the Middle East. There's the attack on the U.S. consulate in Libya that caused a surge in the price.
Beth, will the price be volatile? What is the outlook?
Well, certainly what we're seeing right now is an emotional reaction. Certainly worries about where the supply is going to come from as a result of the Libyan action, and as well as the demand scenario. Will the quantitative easing and the stimulus that the U.S. is inserting into the markets, will that lead to more demand, not only on the U.S. basis, but then will that kind of echo globally? So that really becomes the hope. But a lot of it is just based on hope and worry right now. And when we look longer term, you've really got to focus in on what the long-term projections are. And at this point, it doesn't seem to change. We know that there's a lot of supply and a lot of inventory, and those will be more telling in terms of what the direction of energy prices might mean.
Russ, is price volatility a concern at all for Alberta energy companies, if not drivers, but at least the sector, especially when you pair it with our sky-high loonie?
Most corporations look at the rear-view mirror. They don't look at the short-term glitches in planning. So they'll look at the 3-year average, the 2-year average, whatever. Every corporation is a little bit different. So it's more rear-view budgeting than anything. So a lot of times they'll hedge, perhaps buy some contracts to make sure that they're in line.
So Albertans don't necessarily need to worry about a plunge and losing jobs?
Well, quite the opposite, though. Stocks have a tendency, when the oil is up 30% in the last 3 months, but I'm confident most portfolios are not up 30% in the last 3 months. So stocks have a tendency to lag, go up like they're in an escalator. Commodities skyrocket, and now the commodity goes down, and the stocks, they will plummet. So we're there.
Shafik, a recent article in the Financial Post indicates that Canadians are desensitized to what we're forced to pay at the pumps when prices go up. What's the effect of that? Nothing? We just keep buying it up?
You know, I really don't know what the effect is, Jennifer, but I saw that article, and it's actually really interesting because people used to really be attentive to what the price of gas is, and gas itself has been up to it's $1.33 nationally, and people now are just, okay, well, there's a hurricane, so I assume gas is going to be up. There's a little bit of tension in the Middle East. This is a time where we should see gas reduce in prices. So we should see, the price of the pumps go down, but we're seeing a rise in the price of the pumps because, there's problems with pipeline transportation, there's problems with refinements, there's unclarity or uncertainty in inventory levels, plus the tension in the Middle East. So should Albertans get used to this, expect more of it, and it's going to stay for a very long time.
Beth, is there a tipping point that we could see for consumers?
Absolutely. I think right now we're all participating in a little bit of gas price fatigue. We get kind of used to and desensitized to the higher prices. But there does come a point when we begin to recognize again kind of what that's doing to the bottom line. You could argue that you're seeing some of the growth in our income kind of offset those increasing costs from the gas prices. And I think that you'll reach that breaking point where the growth in income's not going to be quite enough to shoulder the shock of those higher prices, and therefore people may begin to change their behaviors again. Some of it's already begun to happen, and that's perhaps why you've seen some smoothing effect or impact on the higher prices right now.
And maybe, Russ, there's other opportunities out there. For example, what does the market look like for fuel-efficient vehicles going forward?
Absolutely. But the inventory levels are at a 5-year high. I'm actually surprised the gas prices aren't higher. They're up about 12% in the last 3 months. And as I said, the underlying commodity that supplies us gasoline is up 30. So I'm actually quite surprised it's not higher, but the inventory levels are sustaining that lower level, believe it or not.
So it sounds like we could see even higher prices.
Well,
at
we're
the
coming
pump,
out of the
but-
driving season, so unlikely, and the
Okay.
hurricane season seems to be in check, so unlikely at this point.
Next up, the Competition Bureau launches a lawsuit against big cellular providers. That's when the Monday Money panel returns here on Alberta Primetime. Welcome back to Alberta Primetime and the Monday Money panel. Canada's Competition Bureau is suing the big three cell phone providers $10 million each over their use of advertising services. They charge customers who vote in reality shows, pay for parking, or receive daily jokes by subscription on their phones using short codes. Text 12345 to whatever. The Bureau says Canadians don't realize a fee will appear on their bill. Shafik, the companies claim this move could hurt e-commerce. Do you agree?
There could be a slight impact, but the size and the scope of the bill that they're imposing is about $10 million per provider, and in the grand scheme of things, it's a very small portion of their net profitability. The only thing that could hurt in the short term is sort of the media effect, but this is a very growing industry. The telephone companies, the Bells, the Teluses, and the Rogers, long term, they're not even batting an eye over this one.
Could it be an interesting precedent, Beth, for what we can or cannot do on our phones, or what advertisers can or cannot do towards us?
Absolutely. I think this will be an interesting precedent and certainly a bit of a warning across the bow, all in the name of consumer protection. So at this point, it is misleading and can be quite hidden what the fees are associated with some of these transactions. And unfortunately, or fortunately, depending on which side you're on, those cell companies do get a piece of that action. So there is an inherent motivation on their behalf to kind of continue to drive that business.
Right.
So that's what this is looking to really help.
The thing is, though, is Russ, a lot of people have long complained in Alberta and Canada about the fees and the rates that we do pay here for cellular. You spoke to a contact of yours in the business. Their comment over a $10 million lawsuit over advertising?
Wait a moment. They each made $10 million. Totally immaterial from an investment standpoint. Totally immaterial.
So irrelevant.
Irrelevant.
Let's find out what else our panelists are watching this week. Shafik, we'll start with you.
You know, there's a lot on the radar this week. The main thing I'm looking at is the Canadian inflation numbers are due out on Friday. We're hoping inflation comes in around 1.8 to 1.9. That's within the Canadian fiscal policy mandate, so that extenuates the length of time that the monetary policy that will increase interest rates, which is very positive for the Canadian economy.
And Beth, home sales, a big story today.
Certainly, home sales numbers were out, and certainly the predictions and forecasts are that home sales will continue to decline over the next couple of years. Also citing evidence that the change in the rules with regards to mortgage financing have begun to have an impact and slowing that demand on the home front, as it were. That all, of course, is a little bit different in Alberta, as we know. BC, of course, showing slower sales and lower prices. Alberta's certainly seen a little bit of a bucking the trend. But of course, going forward, the concern remains, will interest rates continue to put a damper on that home buying, and really where will the home prices go?
When you look at Alberta, though, we've just talked about $100 oil right now. How much of a buffer is that going to be for us? Will we actually see a significant or slight price drop? Do you think that Alberta's outlook is more of a remain the same, Beth?
Well, in terms of the oil price and the direct tie-in, I would say there's several degrees removed from that. So I think that you can count on probably on par performance from that perspective. But I would say on the home front and on the housing market front that we should expect tighter times going forward, even with a $100 oil price.
And Russ, what's on your radar? September just being kind of a typically blah months for investments and markets?
Historically, it has been. I mean, vacation productivity time is low. It's the fiscal year end for a lot of U.S. mutual funds. We have a real sugar caffeine fix coming with these ECB printing money, quantitative easing, whatever term you want to use it.
The United States propping up its economy.
Propping it up. So we have an artificial surge. So there's some great opportunity here if you want to tone down your portfolio, revamp it for the fall to spring run, which is generally strong. Might be a great opportunity because the U.S. debt situation could come front and center here pretty quick. Europe, a lot of people feel that the euro is safer now. I don't think it's healed. China's slowing. Good opportunity here to revamp your portfolio.
Are you finding good things out there still for investors? I mean, we look at the big factors impacting the markets right now: Europe, the U.S., China slow down, oil prices. You have the tact, though, that you look for the individual stocks rather
Actually,
than
to
a
me,
mutual fund.
it's a great opportunity because everything gets bundled together. Everybody's looking at the big picture, the macro, what's Bernanke doing, what's Europe doing, and everything gets thrown into the kitty.
You can look at one company.
So if you can discern what company is the winner in there, I mean, just because it's paying a dividend, be careful. Don't think that just because it's paying a dividend, it's safe. You have to look at things like payout ratio. But for certain, everything's get bundled together. If you have an attentive eye, you can find some great quality.
And Shafik, you have clients in Calgary. Are they worried about quantitative easing through Europe? How often is your phone ringing?
Yeah, the general consensus of the consumer right now, of the general investor, is that, okay, how much trouble is the U.S. in? How much trouble is the European in? Remember, I mean, the QE3 is flooding the entire world with cash, as is the European bailout fund, which was ratified by Merkel and the European Union just this week, had $600 billion. And India reduced interest rates yesterday. So there's a lot of cash. People are wondering, what do you do with all this cash going into the world? Do we buy gold? Do we buy commodities? So yeah, there are a lot of concerns out there.
And I know that go ahead, Beth.
That being said, I think the real surprise for investors when they open up their September 30th statements will be how well their portfolios did in the U.S. and international markets compared to the Canadian markets.
Thank you all for your time tonight. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. Shafik Hirani, a senior director with Investors Group Calgary, and Beth Hamilton Keene, director and portfolio manager at Moore Investment Management.